G'day team, welcome back to another video, and today we're going to look at two different things. We're going to look at tax on investments, and we're also going to look at how inflation works on certain objects and how that affects how much you have to put away and save and things like that. So just like your salary or pay from working a casual job, interest earned on investment undergoes the effect of tax and inflation. Now, we call this tax the marginal tax rate, and like tax on salaries, it is different depending what bracket the amount of interest falls into, and your income range as well. So these are the old income ranges and tax brackets that Australia used to have and that Hazy is based off of. Now, these have changed over time, but it is still right to use these brackets when working through the Hazy textbook to get the same answer as them. Now, often questions in an exam or in a test will tell you the marginal tax rate that they get taxed at, so you won't have to sort of know that, but we'll have it as a reference here today. So let's have a look. We've got Dan, who has invested $7,000 into an account that paid 3.7% per annum interest compounded monthly for 4 years. We're going to calculate the amount of interest earned in the 4 years, and we're given Dan's marginal tax rate is 45%. How much tax will Dan pay on his interest? And then we're going to calculate Dan's after-tax return on his investment, so how much he actually earns on the investment. So we're going to start by calculating the interest earned, and we do that by firstly figuring out how much money is in the account after 4 years. So we are trying to find the future value. Now we're doing 4 years and monthly, so 4 times 12. The interest rate on the account is 3.7%. He currently has $7,000 in his account. The PMT is going to be 0. We're not putting any more money into that account. And PY and CY are both going to be 12 to match my months up here. So if I put all of that information into my calculator, I've got 4 times 12, 3.7, negative 7,000, 0 PMT, 0 future value, and 12 PYCY. We figure out that our future value ends up being approximately $8,114.74. So to figure out how much interest is earned, we need to do, so interest is equal to the future value minus PMT times N, how much money we paid, minus the present value. Now, we didn't actually make any payments, so that is 0. So I've got my future value is 8,114.74 minus 0 minus 7,000 of the initial investment, which is going to give us a total of $1114.74 earned on interest. So that is the value we need to look at given the tax. So we're told that Dan's tax rate is 45%. So let's calculate how much tax he's going to pay. So he's going to get taxed 45% of the interest earned in the 4 years. So heading to our calculator, 0.45 times 1114.74, we end up that Dan gets taxed approximately $501.63. So then his after-tax return is the total amount of interest earned minus how much Dan gets taxed, which ends up being 1114.74 minus 501.63, $613.11 is his final return on his investment. So even though you are getting all of this crazy good interest and money earned, the government will still tax you. So that's how sort of tax works, and a question like that will work. So now let's have a look at inflation. So inflation in simple terms is the increased prices of goods and services over time. So for example, a litre of unleaded petrol cost $1.80 in 2022. That's now gone up to, $2 a litre in 2024. But it only costs 1 litre 57 cents per litre in 1975. So you can see that that's increased over time. Now that inflation rate increase can fluctuate from year to year, so be careful to check the question for the correct percentages because they're not always going to be the same. So let's have a look at an example. Now I want to buy a house and I know it's going to be in the market in 5 years' time, but it's currently worth $650,000. Now I want to make quarterly deposits so that in the 5 years' time, I can actually afford that house. So if inflation averages 2.9% per year, we need to calculate the value of the house indexed for inflation for 5 years. Now to do this, we actually go to our compound interest formula. So my future value is going to equal my present value times by 1 plus my interest rate to the power of n, and we do it over years. So my future value in this case is going to equal, so I've got my present value is $650,000. 1 plus, now my interest rate is 2.9%, so 0.029, and I've got 5 years. So that means after 5 years, if I put those values into my calculator, 0.29 to the power of 5, that house, that same house that was worth $650,000, is now worth $749,877.34. So it's gone up nearly $100,000 in 5 years. Now, the account I want to put my money into compounds 4.1% per annum quarterly. How much should I deposit each quarter to ensure I get my final indexed result? So coming down to my little list of things, I've got 5 years times by 4 quarters. My interest rate is 4.1%. I currently have $0 in that account. I want to find the PMT. I want there to be a total of 749,877.34. And PY and CY are both going to be 4 to match my quarters up here. So let's throw that into my calculator. So we've got 5 times 4 is 20, 4.100749,877.34, and then 4 for PY and CY. The PMT that comes out is minus 33973.12. Therefore, depositing approximately $33,973.12 per quarter, which is a lot of money per quarter to buy this house in cash. Okay, often you won't buy a house in cash, so in this case it's a reasonable number. In real life, probably not. So thank you guys for watching. Hopefully this helps a little bit, and we'll see you in the next video. Thanks.